Hi, this is the McIntyre Financial Report. My name is Britton Begley. I'm here with Ryan Begley. No relation.
Not at all.
And we're here today to talk about a few things. One thing I want to talk about is taxes. So, I get a question all the time as somebody who has, some tax experience, some educational tax experience. Is my life insurance going to be taxed? Right. So if I die, is my life insurance going to be taxed? Like, does my life insurance get taxed at all? If I put money in life insurance and it grows, does that get taxed? Is the money taxed as I, put, it in there and grow that amount out? If I take it out before I die, if it's one of those policies where I take it out before I die, does it get taxed? So I get this question all the time. So I guess the first question I'd ask you as the expert on insurance is, does life insurance get taxed whenever someone dies and that policy goes to their beneficiaries?
No. So it is. That is the short answer. No, it doesn't.
Video over.
Yeah, we're done.
Oh, yeah.
No, it doesn't. So if it's directed to a beneficiary, if you have $100,000 directed to a beneficiary, $100,000 is going to go there. Now, if you've taken any loans out or anything like that, that will be subject to
being paid back or reducing the survivor benefit. Yeah,
exactly. But the end benefit's going to be what you have it.
Yeah,
it's not going to be taxed. Now, individuals have different types of like 401ks and IRAs and stuff like that, and they get taxed. Of course, if you try to take money out of that, now you can roll those over with tax benefits to like a long-term care or something like that.
Right. Hybrid. So that's a really cool point, because there are, a type of retirement account, which is the IRS calls it a qualified account, meaning it's qualified for tax deferral, which means that if you're working and you're chipping in, from your paycheck every week or every 2 weeks or whenever you get paid, you're chipping into some retirement account. That money doesn't get taxed whenever you get it, right? So when you put it into the retirement account, you're not actually getting taxed on that money like you are the rest of your money that's coming to you through your paycheck. So it like splits that money off, puts it in that retirement account, and that money's not taxed yet. But in the future, if it is qualified funds, if it's not a Roth account, that money is going to get taxed at some point when you pull it out. Yeah. And that's why you have those required minimum distributions whenever you reach age 72, because the IRS or the government is basically saying, hey, look, you got to pull that money out. We got to take some, we got to tax some of that money, right? So you can't defer it forever. So the point you're making, though, is there are policies out there, especially the long-term care insurance policies, where, you can have that money in that retirement account, that qualified fund that hasn't been taxed yet, pay your premium for like a one-time premium for the long-term care insurance policy, and it's a rollover, meaning whenever you pay that, it's tax deferred, doesn't get taxed at that time.
That's exactly right. And the government, why they allow this to happen is they see it as a win-win.
Yeah,
They see it as you're not gonna, eventually go on Medicaid and take those type of resources, and as well. So
which you paid into, by the way.
Exactly.
And you're entitled to.
You definitely, 100%, but the government doesn't see it like that. We do, the government doesn't.
Right.
But this is a win-win, because you get to take the money that they were going to already tax and use it for long-term care that they don't have to pay for.
Right. So, I want to kind of focus in on this, because this is huge to me that someone could take, because you have someone looking at a long-term care insurance policy and they might say, hey, I can't afford those monthly payments, or it's just not within the budget that I want to have, right? Because when someone sits down with a financial planner, a lot of times they'll come up with a budget, like, what's your ideal budget for retirement?
Yeah, it'll be like, can you do $200 a month in long-term care insurance? And some people can't.
Yeah, some people can't. And sometimes you're like, man, $200 a month, that throws off my ideal budget. I can't, buy all the things that I want and also do the vacation, things like that. It's gonna be hard for me, right? I don't have much room for error here. So what if I took some money that's already going, already in my, it's locked up in a retirement account for all intents and purposes, because if you take it out, you get taxed on it.
Yeah.
So what if I could use that, and then it gets rolled over into this policy, and when this policy pays out for me, is it taxed at that time? It's not taxed at that time. So you get to essentially forever defer the tax on that money.
Oh, it's super awesome.
Yeah.
Yeah, it's a super good deal because, and it gets essentially, if you say you take 50,000 out,
right,
and then it pays for $100,000 worth of protection on you in the long-term care, and that's doubling your money.
Right.
Then you don't have the taxes, so that's helping you.
Right.
So you're getting a pretty good deal. It's a super awesome deal.
So I guess that begs the question. If someone was doing that, let's just assume it's a long-term care insurance policy. They're looking at a long-term care insurance policy saying, should this be something that I do? I get this benefit of tax deferral, but am I ever actually going to benefit from that? Am I actually ever going to need long-term care? But we know that over 70% of individuals will need some type of long-term care at some point in their lives.
Yeah, it's almost guaranteed unless you're going to die.
Yeah, unless you pass away before. That's what skews that number. Exactly. It'd be more like 90%
That's exactly
will need long-term care. But people pass away at a certain age, right? And it skews the number. And the other thing is that number is going up. And the reason why the number is going up is because medical technology is amazing. Yeah, it keep people alive, but the health span of people, the lifespan, has increased to a certain point. Yes. Now that number has been skewed too because of a few different reasons. Yeah. Lately, COVID. So that hasn't gone up in the last couple of years, but it is steadily increasing on average. But health span has stayed the same or even gotten worse because of the way, and we got all these processed foods. We got, people getting diseases of abundance, right? Because
a lot of people get Alzheimer's disease, or they have a stroke or something like that, where they can recover from that stroke, but they're going to need help recovering from it or something like that, or they never do recover from it.
So more and more people are outliving their money, whatever they
exactly. They're all, that's probably the biggest crisis in America happening to us now, is not like all these crazy things you see on the news. It's our elderly. Our elderly is they're being left in the dust because they didn't save up enough money, or they thought a 401k was gonna pay for all their
or they saved up money that they thought was going to be enough, and then the cost of long-term care decided to become $10,000-$15,000 a month, and then we have inflation and all that good stuff.
Yeah, they just decided to go crazy on long-term care.
Yeah, it's wild.
It's insane. When I first got into this, I was looking it up, and I was like, oh, that can't be right. Yeah. I was honestly concerned, because I was like, that can't be an honest, you can't. Yeah. You can't charge $10,000 a month just to take care of somebody. That's insane.
Yeah, and don't get me wrong, these people who are working at these facilities work hard. It's not an easy job at all, and you deal with a variety of individuals, variety of personalities, variety of states of needs, different needs for different activities of daily living. But my God, the cost of care just cannot be justified at what it is now. And the thing is, it's not like these nursing homes ain't making money. They're making money.
Oh yeah, they're making.
Their margins are huge if you just look and do the math, right? Mm-hmm. And I was saying the other day, it was funny. I was talking about this the other day to a client, because we were talking about the cost of long-term care, and I said, it's amazing how they can cap rent in a city like New York, but we can't cap the cost of long-term care for our elderly. Yeah. And the thing is, we think about the elderly as the other. We're all going to get there if we're lucky. Yes. Right? We're all going to get there. And guess what? The baby boomer generation was the biggest generation ever until the millennials. Mm-hmm. And that's a lot of people. And all of them are getting to that retirement age, getting to a point where they're going to need some type of, long-term care very, very soon, God forbid. And so we have the whole baby boomer generation, if they're still alive, looking at this, huge risk of having to pay tens of thousands of dollars a month. Yeah. And that's wild. And so that's why, if you're looking at a long-term care insurance policy, these flexible ways to pay for them are very important. Not only are you able to help, cover the cost of care with a long-term care insurance policy, but you're also able, through certain types of long-term care insurance policies, defer tax.
Yeah, now, and a lot of people think that long-term care insurance is going to be super expensive. It's not as expensive as it used to be. I can get a reasonable price to pretty much anybody. Right.
Right. And that's a great point, especially when you compare it with the cost of long-term care.
like to me, it's like a no-brainer.
Yeah.
Especially if you're in your 40s to 45 and you really start thinking about getting it, because that's when it's really, really low for you.
Yeah.
And you can also write it like it has tax benefits when you have that policy.
Right.
So if you're like, let's say you're over 60, there's a certain amount of money you can take from your taxes if you itemize, from that policy.
Right.
So your premiums are actually lowered because you get to write it off on taxes.
Right. Yeah. Which is also a nice thing. So I guess taxes are really what we're talking about today. So I want to we zoomed in on the long-term care, but let's go back to taxes. All right. So what if I have a life insurance policy or a life insurance policy with a long-term care rider, which could also pay for long-term care, or if I never need it, or if I don't use the full amount of the cash value, it could pay, or the benefit, right? It could pay out for my death, right?
Yeah, also, the long-term care rider is it's called an accelerated death benefit, and if you are sick, terminally ill within 24 months, it'll actually pay you your benefit.
Oh wow!
It'll pay you at least 80% of it.
Wow. So basically, if you are terminally ill and they'll pay out 80% of it, knowing that you're gonna pass away likely in the next 24 months.
So it's either like give it to your family or go take a vacation in Greece.
Yeah. Well, there you go. So that's awesome. That's awesome. So that money wouldn't be taxed. The death benefit wouldn't be taxed. What if I'm putting money in that life insurance policy and it grows? So what if it's like a participating policy where they invest that money for me and they grow it?
Only on the growth.
Only on the growth. Okay, so you could be taxed on the growth itself. Yes. Okay, and I guess that would be a capital gains tax.
Yes.
Okay, if you sell the investment, right?
Exactly.
So what if you don't sell the investment? Are you taxed on it? You realize well, let me answer that question. I'm the attorney. You don't realize the gain on something on a capital asset that you don't sell. Yeah. So that's good. That's a good thing.
Exactly.
What if I have a life insurance policy and I want to be my own bank?
Yeah, so that's something that's super awesome that you can do. It's a very complex thing. A lot of people, they have a lot of arguments saying, can you do this? Can you not do this? You can. It is not as complex as people think it is. It is quite easy to do because what you're doing is you're taking a loan from your insurance policy.
Okay.
And then you don't necessarily have to pay that loan back. But if you do want to pay it back, if you don't want to take it out of your death benefit, you want to pay it back, you're essentially paying yourself back because you're eventually going to get that death benefit.
Okay.
So it's called a living benefit.
So let's say I start a policy with you. Okay. I have a life insurance policy. It's the type that I can borrow from.
Yes. And
I paid in for 6 months and I pay in, $5,000 cash value. It's a $100,000 policy. Can I borrow $100,000 after 6 months?
Depends on the policy. It gives you that limit. So you can borrow up to a certain amount of your death benefit.
Okay, based on how much I paid in over time.
Yes, exactly.
Okay, at some point it's going to be a paid up policy and I can take it all out.
Yes.
Right?
Oh,
okay.
Yeah. So like 100, sometimes it's up to 100. They just 100 years they just write you a check and send it to you. Yeah. Because you're good. If you lived over 100, they're like, here, just have
yeah. You made it. You did it.
Yeah, there's a lot of stipulations on what you can and can't take. It depends on the policy, it depends on the company.
But conceivably, if I'm saving money, right? If I'm a person who wants to save money, and so I'm saving, let's say, 30% of my income, and so I decided to say, okay, I'm gonna put 15% of that in life insurance premiums, and then the other 15% in the savings account. And then at some point, I'm going to be able to borrow the amount of premiums that I've been paying into that, and I'm borrowing it from my death benefit.
Yeah. So you can either take a loan out that can come from the death benefit, or you can take the cash value out.
Okay.
So those are two different things.
Gotcha. So likely I'd be able to take more money. This is where the loan part really comes in, where the benefit really comes in, is that I could take more money than I actually paid into the policy.
That's exactly right. Yes. That's why it comes from a death benefit.
Well, and so there must be some stipulation that I keep the policy, though. Like if I get rid of the policy, I have to pay the loan back.
Oh, yeah.
The difference between my cash value and the death benefit.
You're gonna have to keep the policy. You can't take out a $100,000 loan against your policy.
Yeah.
and cancel it. That's fraud.
Peace.
Yeah. You can't do that.
Just pull the rug out from under them. Yeah, you know, so what I want to do at first, if I'm ever going to use a policy, and this is, you know, for you young folks out here, you know, starting a family, building a home, building a life, that sort of thing.
If you're 25 years old and you don't have a life insurance policy,
you're messing up. You're messing up. Yeah, because this is a big deal for someone who's going to be contributing to this life insurance policy. At some point, you know, loans are a funny thing. Getting investments from banks, whatever it is, right? What if I want to start my own company and I don't want to go through the small business, you know, association to get a loan, or you know, go through a bank to get a loan? And what if it's just a little bit of money that I want, or I'm making a good income, and so I want to be able to be my own bank in the future and borrow more money so I can make big premiums right now, because that's money I could always get out anyway. You know, if I'm young and I'm making a decent amount of money, this is a no-brainer.
Yeah. Oh yeah.
You know, especially if I'm wanting to invest. If all I'm wanting to do is earn a salary, retire, and live the rest of my life, I still want life insurance, because guess what? Someday we're going to die, right? Yeah. And if I have dependents, if I have children, or if I want to leave behind a legacy, I want to leave something behind for them that won't get taxed.
Well, this is what I tell my clients sometimes when I'm talking to them. I go, how easier would your life have been if your parents had a $300,000 life insurance policy?
Yeah. Oh my God.
And they're like, holy crap. Yeah. Our parents, if they, you know,
they're still alive, but if they had one, you better watch out now. They're both of our parents still alive, don't have life insurance. And the idea, you know, there is that, you know, we have parents who worked, they were entrepreneurs, right? And really just scraped made a buy.
Yeah.
And the thing with us is that, you know, we're in a position where we had to make it ourselves. If we knew down the road that there was a life insurance policy left to us, I mean, there would be a lot of benefit there. Heck, I'd pay for the thing if you know, if that were the case. But it's not. So you don't have that security, that knowledge that someday, if I ever want to retire, if I want to do something, I have that coming to me, right? Because maybe they didn't have the education on it, maybe lack the wherewithal to understand the importance of it, or they just said, hey, we'll have 7 kids and see what happens.
Yeah,
right?
That's exactly right. But if all of your family, so let's say all of your family decides to make the beneficiary a trust,
right, and
people are dying and they keep putting money into a trust over and over, and that's a family trust, y'all are going to become millionaires. Like,
your family is going to be able to pull from that trust for a bunch of different reasons. Yeah. Like, for example, like, you know, we're pretty close.
Yeah.
In fact, we even work together. Yeah. And if we, you know, have children and decide, hey, you know, one of our policies or both of our policies we're going to leave to a trust, and hey, we want to make sure our children aren't knuckleheads and they are not spoiled with that money. It doesn't just go to them and they buy Ferraris and live it up. We want to pay for their education, their health, their support, things like that. Make sure they can get through college, get through a good college, actually make it out, and put incentives in there so that money comes out only for things that they need, right? And then you get maybe you buy a house, things like that, right?
Yeah.
And stipulation on that is you have to have your own life insurance policy that's paid to that trust for your children,
exactly,
right? I mean, that's how you build generational wealth. With estate planning, the right type of estate planning, the right type of insurance, you can really build generational wealth like the Kennedys, like the Rockefellers, that sort of thing, without having a big, huge, amazing business that, you know, just made a whole bunch of money. Now, you might think to yourself, okay, well, that's all well and good. You're building generational wealth. How in the world do you do that and still avoid the dreaded death tax, that estate tax, right? So that's a big one for a lot of people. You know, that's something that I think is an important thing to do to try to avoid. Now, the basic thing that you need to think about when trying to avoid the estate tax is your estate is taxed if it's over a certain amount. Okay, so they add all the gifts over, you know, a certain amount that you've given during the year that you had to report. Currently, that's $16,000 per person per year. So if you make a gift above that, you have to report it. So they count all those plus the value of your estate whenever you pass away. If it's over a certain amount, they tax you up to 40% of your estate. Yeah. That's a lot. 40%? So, 40%. So it can be all the way up to 40%, which is wild. So The thing is the idea is that if your estate doesn't have that value, if it's under that value, it doesn't get taxed. So how do you avoid that? You get things out of your estate, right? So it doesn't count as your asset whenever you pass away. This can be done in various ways through certain type of trusts, especially. There's a bunch of different trusts out there for, that will meet your needs or, a bunch of different people's needs depending on what they are. However, there's no lack of creativity there when trying to avoid taxes. But the thing is that no matter how you get to it, is whenever you give those assets to a trust, you're it's not that you're necessarily writing them off. It's not that you don't necessarily benefit from them, because there's things like a annuity trust where you get the money back, things like that. But insurance itself, while it's not taxed, it is counted in your taxable value for your estate. Okay? So one of the things that I do for people, that I suggest to do all the time, is you set up this life insurance policy that has this value. This value is going to be added to the value of your estate whenever you pass away, so it can subject you to the estate tax. Why don't you just go ahead and put that thing in an irrevocable life insurance trust now? Right? So what that does is it allows you to have the insurance. It allows you to benefit from the insurance insofar as that it goes to your loved ones. It accomplishes the need and the goal that insurance has, right? But it's in a trust, in an irrevocable trust, which is not in a part of your estate if you do it correctly. And so that won't count against you as an asset whenever it comes time to look to see whether or not you're over that estate tax threshold and can be taxed. So we call it an ILIT, irrevocable life insurance trust. Those are incredibly important for those who are looking to do life insurance or already have life insurance policies. If those are just floating out there, not in a trust, you really want to consider putting them in an irrevocable trust, because that could be a huge benefit. So I think we've hit on most of the taxable nature of life insurance, how to, or even long-term care insurance, how to maximize some tax benefits here.
Well, that's what we're here to do. We're here to help people get them money and mainly keep their money.
Yeah.
Everybody's trying to take your money nowadays. It just seems like everywhere you go to the grocery store, you go anywhere, it's just like.
I think that's what ticks me off so bad about, the whole, cost of long-term care thing. It's you work hard, because I imagine how hard I work every day, right? I mean, I feel like I work hard. I run a law office,
you pay
right?
Taxes.
I pay taxes. I pay a lot in taxes. Okay, all of us do, and if you work, and you work hard your whole life, and you try to save, right? You try to save, and they're trying to pick you apart with taxes, with different things, right? I mean, inflation's out of your control. You're paying $5 for a gallon of milk. I mean, that's wild, right? I mean, you can't. There's nothing you can do about that. So that the money's coming out there. The money, the health insurance is way too expensive. All the stuff, and then at the end of your life, when you save something, despite all of that, they want to take it because they think it's okay to charge $15,000 a month for long-term care.
Yeah, it's insane. It's criminal almost.
Yeah.
If you think about it.
Yeah.
Yeah. I would.
That's what kills the American dream. The American dream is that you can come to this country, you can make it, and you can pass that on to your children. But that's we're at a point where you can come to this country, you can make it, but we're going to take it from you.
Yes. Yeah, that's 100% right. And that's why we have gotten into this business of making sure that people keep their money, avoid unnecessary taxes or unnecessary pay. Right. And that means that, and we get creative. We love getting creative and making sure that you can keep your money and making sure that you get the right policies. Because like I'm a broker, so like I don't work with one agency. I'm not a captive agent. In other words, I work with multiple agencies to get multiple carriers, so I can get the policy that's right for you. Right. And then me and you work together and make sure it all wrapped up nice and pretty little bow for them. That's
right. So you want it to be comprehensive. You want to make sure you don't have a broker, an agent who is biased on.
Actually, one thing I was going to say, I don't mean to interrupt, but I talked to a lady the other day. I looked at her insurance policy because she's like, "Sir, can you help me?" And I was like, "Oh yeah." So I looked at her long-term care policy. The agent wrote it 20 years ago. Yeah. But wrote it to where it goes up every 5 years. Yeah. And now she can't afford it.
Well, see, the problem.
She's paying $400 a month, and I'm like, this is insane.
See, that's the problem. The problem with a captive agent is that it's like a car salesman with a lot full of cars, and all they can sell you is those cars.
Yeah.
They can't go to another car lot and sell you those cars. So if you're looking for a certain type of car, and they're gonna want to sell you one because that's what they do. They need to sell cars to feed their family, whatever.
Yeah.
So they're gonna sell you one of their cars, even if that's not the right car for you. Right. So what you want is a non-captive agent who's going to look at all the different companies who offer these policies and pick the right one for you, because they're not biased or they don't have an incentive to sell a certain company's products because that's how they get paid, right?
And when I say we have free consultations, you can bring me a policy
right
that you've looked at someone else and bring it to me, and I'll look at it and be like, hey, yeah, that's a good policy, or that's not. I personally wouldn't give you that policy, something like that, because when I write a policy, I make sure that they get to see what their payment is throughout the whole policy.
Right. That's important because things go up all the time. It surprises people. It makes them resentful. They cancel their long-term care insurance policies, and then boom, they need long-term care, and where they have that.
Yeah, then it takes all their money.
Exactly.
And she asked me, she's like, "Do you think I need to cancel it?" I said, "No, ma'am.
Yeah.
Like this, you're stuck in this boat, and I'm sorry you're stuck in this boat, but do not cancel that." Because she's literally like 82 years old.
Yeah.
And I'm like, don't do that.
Yeah.
Because I don't want them taking all of your assets.
Right.
Which would be horrible, because she's worked all her life for it.
Right.
And it was part of a company. It was just a really sad situation that I wish I could have helped her more.
Right.
And I couldn't. But
right. So I guess the moral of the story is do your due diligence, or let the professionals do it for you if you want to learn how to avoid unnecessary taxation. Mm-hmm. Want to provide a legacy and preserve your assets, give us a call, 704-259-7040. You can call in and ask for either me if you want a consultation with regard to anything, with respect to estate planning or elder law, and do yourself a favor, give Ryan a call, and make sure you schedule a consultation with him. Even if you have insurance policies, let him review them and tell you what's best for you. I think that was great. Thank you, Ryan.
Thank you.